again, if your deal only works because of rent growth, then that is a bad model, bad deal.
Well, three
So
years ago, almost every deal was only working with that. Am I right? Or you really couldn't, it was, in 2022, 2023, it was pretty hard to buy a deal if you weren't factoring in something like that, right?
yeah, but again, what happened to a lot of those deals right now?
Yeah,
So
you're not wrong. They're either punishing with no money at all or they've been foreclosed on.
yeah, so again, if your deal does not work without that rent growth, then it doesn't work. And rent growth should be gravy. It should not be like the major assumption that makes the deal work. So. Welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and I got my good friend, Frank Patalano, with me here today. How are you doing, Frank?
Hello, sir. Good. Just trying to figure out more ways to make money.
Yeah, that's all why we're all here, why everybody's listening to it, because I think we're all wanting to make money. So we all have these grand ideas. It's just nothing actually makes it happen.
There you go.
Today I wanted to talk about because this is coming up, and there's something weird going on in the market I'm investing in, which can bring this up as well. But what is rent growth? How do you calculate it? And is it just a crystal ball? It's like, are you just like hoping and guessing? Are you like sticking your finger in to see which way the wind's blowing? How do you know what to use for rent growth and when you're underwriting? So, you ready to jump in?
I mean, it's easy. The answer is 3%. We just ended the whole conversation, right?
Yep. And if you like this content, you can catch us at LinkedIn and YouTube and Instagram, and we'll catch you next time. Bye. No, so 3%, just leave it at 3% and you're done, right? That's all you have to do. Um,
Definitely not.
so I know I had some clients come to me, and this was a few years ago. They were underwriting a deal in San Antonio, and they literally had 30% rent growth year over year for 5 years.
Wow.
Yeah.
I mean, that sounds like Phoenix was like 25% for like 2 or 3 years in a row, and that was scary too. So,
Yeah.
past
So,
performance does not make future results or something.
right. Um, so I was like, I pointed that out and say, hey, you're underwriting for 30% year over year for 5 years. And they said, yeah. And so that's why we can afford this price point, which they were going to make like a 17, 18% IRR on. So I think you can do the math on that. If they don't make that rent growth,
That's pretty scary.
they're going to have like probably a negative IRR.
Did they end up buying a property that you know of with those assumptions?
I think they submitted an LOI, but I don't know if they were awarded it or not. So
All right. Well, this
you
was a few
you
years ago, so maybe by now they've already turned the keys back in.
yeah, usually with my clients, I either catch them like after they submit an LOI or like right before, and then they don't tell me anything about it afterwards. So, and maybe I should follow up more. I don't know.
That'd be good discussions on how the underwriting actually worked, especially after you sell the property later.
Yeah. Um, but right now, and right now it is the summer, almost the summer of 2026. Abilene, Texas has some new data centers going in right now. Our manager manages properties in Abilene, and they are currently getting rent growth of 30% or more as well. Abilene is having a housing shortage right now. So they're getting 30% for the last year or so, and for probably the foreseeable, 30% over like their base rent. I don't think they can do 30% year over year. Once they elevate it up 30% on the first year, then they probably elevate it like 3% after that.
So you're saying like a
Uh,
one-time rent bump because of the needs, and then
Correct.
4 years from now or 3 years from now, when all the new housing stock is built, it'd be a good time to worry about those rent bumps.
Yeah, or when the data centers are complete and they don't have those transient workers there anymore, then they all leave town and go on to the next town. You're going to have negative rent growth. Go back to your base that you were at before. So,
Revert to the mean.
yeah. So you can experience like these temporary trends in markets. You can benefit from them, but I would not underwrite to them. It's like, yeah, the same thing happening in my market is we have data centers coming in. They're going to break ground in Q4 of this year or Q1 of next year. Again, this is summer of 2026. So, what's that going to do with my properties? Are all my properties going to jump up 30%? I sure hope so. But am I expecting that to happen? No. And so, those rent bumps are just gravy as far as I'm concerned. What do you think?
No, I agree with you 100%. I mean, not to get too far off topic into the weeds, I've looked at a lot of stuff in the Salt Lake City market, and north of Salt Lake City on the way to the Idaho border, they built a brand new Amazon place a few years ago, and you saw the prices of the rents start to go up, and you saw the housing prices start to go up a little bit. Well, guess what? They never actually turned that into an Amazon distribution center. It's been sitting there for years vacant, and it's like
Really?
oof. And then you saw a change. It's like, well, nothing's going there, so the jobs aren't going there. So do we really? You can't continue that rent bump and the house prices difference.
Yeah. And I also want to say rent growth is different than like renovation premium or bringing it up
Yes,
to a market value. So
people get that wrong all the time.
if your rent is 850 and your market will support 1,000, you can bring rent up $150 for that unit without maybe doing anything at all. That's not rent growth. That's just bringing it up to market. Your rent growth is how much does it grow year after year after that. And so a lot of times what I do is if I'm having a premium on the rent, I'm not even going to increase the rent 3% for like the first year because I'm already increasing it $150. Why am I going to increase it at 3% on top of that, you know? So then you get your rent bump and then maybe zero rent growth after that. And then maybe you can do 3%, 2% after that for conservative estimate. So,
Maybe it was a year ago, maybe it was 2 years ago. I remember when we were underwriting deals and we were looking at like 0% rent growth for the first 2 years
no,
and then 3% after that,
yeah.
you know?
And places again like San Antonio, Dallas, Phoenix, they all experienced negative rent growth. There's almost the same thing. They were getting 30% year over year, and then it all of a sudden drops because people are either moving out, going to different places, or the housing caught up, and there was less competition. But whatever, people were not paying those elevated rents, and so they needed to bring them back down.
I think it
So,
was a combination of two factors. Factor number one was that for the average person, the price of rent got too high. And factor number two, it was build, baby, build. And some of the places like Austin, I mean, long term it's still a good play, but short term, they built a lot of housing, and some of that housing needs to be it needs what do you call it when everybody starts to fill those units?
lease up.
Yeah, kind of basically the lease up, but in general, absorption.
Oh, absorption. Yeah.
Yeah.
So,
So I mean, what's a good number? And would you agree that it's market specific?
it's definitely market specific. Definitely don't use temporary trends. Um, but like no one knows the future. No one has a crystal ball. At least one that can tell the future. If you do, get with me after the show and we'll put you on as a guest. Um, but
Or borrow it
you,
and test it for a few minutes.
but you can look at what your market's doing. Is the population growing? Is there good employment? Is employment growing? So yeah, we're going to get data centers and we're going to get like thousands of new employees for the next couple years. But long term, I think we might only get like hundreds of employees for it. So I mean, yeah, it's still good and it's still growing, but that's what you want to look at. And that's when your market analysis comes into play. It's like, what is the trend? Is the population constantly growing? Is employment growing? Um, Unemployment, is that staying steady or dropping, or is that growing? So unemployment, if that's growing, then you may be lowering your rent growth. So um but generally I do not do more than 3% per year. Now, if I have a property manager who for $1,000 rent increases rent $25 every quarter, by the time a year rolls around, we've just increased rent 10%. So to me, that's gravy. But then you also get into the loss to lease part as well. So because someone who leases in January is going to be paying significantly less than the person who pays or signs a new lease in October, which would be potentially like $75 more a month, so.
I think the main thing we have to think about here is, especially like you mentioned, loss to lease. The concept is that there are plenty of units that are being, well, when we talk about median rent, the median rent's in the middle. So there are definitely people that are renting at a discount for various reasons or because they're not paying attention. And when you go from that and the property trades or the property sells, and you bring it up to market rent, that's not rent growth. That's just
Yeah.
catching up to the market.
Yeah. And that's what we were getting at before. There's a difference in bringing it up to the market and then the rent growth. So, but loss to lease, your rent growth and loss to lease are tied. And depending on how you increase, are you increasing rents? Like every January, we increase it 3%, period, for everybody. Well, the people who signed in December have a full year before they get that rent increase because you just increase it in January. So that's where your loss to lease comes in. And I mean, theoretically, you would want to spread it out. Like our old manager used to do it every quarter, which I was fine with. That way, keep the loss to lease lower. But also, how are you doing? Like, are you doing concessions? Um, are you giving a $500 concession, but are you still increasing that market or that rent every year based on your rent growth? So, I mean, are you adding that rent growth to the concession as well? So, if they're getting 500, then now they're getting 500 plus 3% or whatever. So, I mean, there's a lot of ways you need to think about the rent growth. So,
When you talk about concessions, I'm just thinking about there are certain markets that are definitely more concession heavy than others. I know that I've owned properties in places that they're always doing rent specials, and I don't know, that just makes me nervous.
in concessions, I think we talked about it in another podcast, and it could be its own episode. But concessions, if you're constantly doing concessions, then I think you're having an occupancy issue. We generally don't do concessions unless we do have an occupancy issue. If we're sitting at 90, 95%, we're not offering concessions. There's no need to.
You don't need to.
Yeah. One of our properties, we're sitting at 98 to 100%. I think there's one unit vacant right now out of 72. Um, there's no need to do a concession on that. And I think it's already pre-leased. So that brings the occupancy, the 30-day trend up to 100%. So,
It's always nice when it's trending at 100% and at the end of the month there's zero delinquency.
yep.
So I
So,
mean, what's the most confusing? Loss to lease, market rent growth, operations. What confuses the average operator the most?
actually, from my students and from my clients, loss to lease they don't understand it. Um, I try to explain it. I've explained it here. I don't know if my explanation is good because I don't get any feedback really from it other than from you. But I think you already knew what it was. My students, I explain it to them until they understand it, but I still think it's like a confusing concept to them. It's like, well, how do you calculate it and stuff like that? So, um,
So if someone brings you data and they have the market rent growth like precise, like they're saying it's going to be 3.2% for the next 3 years in a row, versus just being a little more uncertain, which one would you rather see?
um, so if they're bringing me market rent at 3.2%, and that's what they're predicting it at, but that's what the like maybe like the 3 year or 5 year trend previous was, I would probably still just do like a blanket three. I wouldn't go into the weeds on that. Um, I mean, what are you looking at? I'm pulling out a calculator here. You're looking at for like $1,000. I'm not even using a calculator.
Yeah,
You're looking
30
at
bucks.
30 bucks versus $32. That $2 is not going to affect too much. I think you're going to make that up other ways or lose it in other ways based on like
Yeah.
payroll and stuff like that. So sometimes it's not worth chasing every dime whenever you have dollars to worry about. So
I just remember a quote like it's a British joke about penny wise and pound foolish.
yeah, and I'm not saying it's pound foolish. I'm just saying your return on investment on calculating it down to that penny is it's not worth your time to
No,
do
I agree
that.
100%. I mean, I remember there was somebody that brought me a deal in Dallas, and there was so many red flags on the deal. They were newer people. They had never done a deal before. They were looking at some massive $29 million deal, and they were all excited that the rents were $75 below market. I'm not sure if that's the number they created, if that's the number that was on the OM, but I told them, I said, oh, if you're over $1,000, $75 below market might just be like granite versus other countertops. You don't know what kind of amenities they have. Do they have a pool? So that didn't surprise me that much, especially in a market that it was, there's a lot of syndicators in Dallas, and this was on the open market. So it's like, is it really that? And what is your rent growth, you know?
Yeah, and I want to point out, does your deal work if you put in zero rent growth, or does your deal depend on you to have that rent growth? Like with those San Antonio people that I had as clients many years ago, their deal depended on them getting that 30% rent growth. If they put in 0%, their deal would have never got off the ground. So yeah, your 3% might feel conservative, but if it's required to get the returns you need, then I think that's a big red flag right there. That's a red flag, a little red flag you're going to have to actually search for. But yeah, it's a red flag. If you put in 0% and your deal falls apart versus 3% and it barely scrapes by, yeah, it's not worth it. So
Um, how much weight do you put into asking rent versus the annual actual signed lease, especially like we said, we're saying concessions, so especially if you give a month free and stuff like that.
what do you mean by that? I'm trying to understand the question.
How much weight do you put on what they're asking for rent versus what they actually sign the leases at?
So like what their market rent is for like new leases versus the
What they're
concessions
actually
that.
signing at. Yeah.
So I I count like market rents, market lease. So if it's to say 1,000, but you give them like half a month free the first month or something, so that brings it down to 500 for the first month. I would calculate it based on like for the GPR based on the market, but then I would add in the concession to bring that back down so that it so the accounting is right. Yeah, you can go in and you can say, well, we'll be 500 for the first month, or you can annualize it and say, well, let's say 600 for the year instead of 500, just because it's like $50 a month lower. So you can go in and say, all right, it's like the same as like 950 a month versus 600 off the first month. So, um, but I would keep the rent as rent, and I would put the concession in as a concession. I wouldn't mask the concession into the rent. Is what I would do. Does that make sense?
Yeah, I mean, in the end, asking rent is just the marketing.
Yeah,
Uh, and then like we talk about burn-offs and concessions stuff like that. The signed leases are the actual evidence of what market or what rent should be.
yeah. And if you're selling or if you're buying, it's like maybe the seller or the new purchaser doesn't want to have any concessions. That's their choice. So then that means that that rent is going to go back up to whatever they originally signed their lease at. So it's like you're not going to get everything perfect. Like I said, no crystal ball, but you do want to go in disciplined with your best foot forward. So
So
um,
what's the easiest way to calculate actual rent growth? Even if you're not perfect at it, what's the best way to calculate it?
so like actual rent growth, what you're actually getting.
No, what you're actually going to estimate for the underwriting.
And it all depends like on your market analysis if your market can support rent growth or if it's been stagnant for the last few years, you might want to make it stagnant. Um, Ideally, you do want to increase it eventually. So it's like I said, when we're doing renovations or we're bringing it up to market, we're adding in zero rent growth because we're already increasing the rents up to market. And then once we're there, then we'll increase it maybe 2-3%. So does that answer your question? Kind of a
Well, I mean,
hard
let's ask a
question to
different way.
answer.
So the first question would be, what actually drives rent growth? Let's talk about that. So, I mean,
So
obviously job growth, wage growth, population growth, etc.
inflation. I
Yep.
mean, when you're having to pay your employees more, employees expect to get raises every year unless you're bringing in new employees every 12 months. Then you're having to retrain, and you don't get quality employees that way. So if you're going to retain employees, you have to pay them what they're worth. Taxes are always going up, whether it's not the millage rate, it's the tax valuation. Occasionally it goes down, but generally that goes up. So rent growth is really just there to help support that. So um, expenses, how much a toilet costs goes up every year pretty much. So really the only time you would see negative rent growth is when you have vacancy because people aren't willing to pay those higher rents for whatever reason, or you have to lower rents to get people in the door. So
So yeah, there's demand side reasons why the rents would not grow, and the supply side reasons why the rents would not grow.
yeah. So I know a lot of models out there. You put in like a single value for rent growth, 3%, and that's what it is. So a lot of models can't model 0% for the first 2 years and then 3% after. And unless you're like an Excel whiz and know how to manipulate the formulas like that, most people aren't gonna be able to handle it. So again, if you're interested in being able to model like that, you can sign up for the live beta of Ironclad, which is my underwriting model or underwriting software. You go to ironcladunderwriting.com/beta tester. It's free. I'm looking for feedback. But yeah, it'll let you go in year over year what you want for specific rent growth. It'll let you do it annually, quarterly, semi-annually. So
So basically, most models you're saying when they're calculating rent growth, they just have to keep one number the whole time, but and you've created something that allows you to adjust it up to 4 times a year.
correct.
That's cool.
Um, Really, I created that model based on my experience on how properties are run. And like I said, most people don't just do a 3% increase in January and do that every January. So if you have a single family home, you can do it that way. But if you're looking at multifamily, you're generally not doing that.
How do you draw the line between reasonable and aggressive rent growth?
So I think we already looked at it or talked about it. Is one, what is
I
the
mean, we talked
market?
about numbers, but what's in general?
So market analysis, if you have population growth and everything, I would say 3% is reasonable. Anything above 3% is aggressive, even if you
It's higher
can
and
get
higher
it.
risk.
Yes. But sometimes 3% can be aggressive if you've been facing trends where it's been negative the last few years. What makes you think all of a sudden you can start increasing it? Sometimes
Yeah,
you
you're
can.
not underwriting 3% in Phoenix right now.
Yeah. So again, you might want to do 0%. I don't know. Will your deal work if you have to decrease rents 3% every year? That would suck. I probably wouldn't get a deal if I had to do that. But sometimes you actually have to do that, even though you didn't underwrite it to that. So, um, but anything over 3% is a red flag. Um, anything double digits is a huge red flag. I wouldn't even look at that. But if you're sitting around 2-3%, and you're unsure, that's when you have to do a little bit more research and a little bit more nuance to it. It could be correct, it could not be correct. But
Do you
again,
consider rent growth to be the most important assumption in multifamily underwriting?
so again, if your deal only works because of rent growth, then that is a bad model, bad deal.
Well, three
So
years ago, almost every deal was only working with that. Am I right? Are you really couldn't? It was in 2022, 2023. It was pretty hard to buy a deal if you weren't factoring in something like that, right?
yeah, but again, what happened to a lot of those deals right now?
Yeah,
So
you're not wrong. They're either punishing with no money at all, or they've been foreclosed on.
yeah. So again, if your deal does not work without that rent growth, then it doesn't work. And rent growth should be gravy. It should not be like the major assumption that makes the deal work. So that's my take.
And you're sticking to it.
Yeah. What is your take?
No, overall, I agree.
Yeah.
I'm
And
just
that's why we're business partners,
skeptical.
because we're aligned and how we feel the numbers should work. So
Yeah, like I said, I'd rather be safer and underwrite at 0% for 2 years in a row. And then if you are able to squeeze out some rent growth, you're talking gravy.
yeah. So is there anything else? And again, rent growth, annual rent growth is not the same as bringing it up to market. Um, and this is the TLDR. If you didn't want to sit through everything, you can just skip to this point of the podcast. Um, Rent growth should not make or break a deal. It should be gravy, and it's market driven. If you have a deal that's only dependent on rent growth and you want someone else to look at it, or maybe run it through a model that can handle 0% for 2 years before you increase, you can look me up. I can help you with that. You can go to ironcladunderwriting.com and we can help you. You can look us up at LinkedIn, Instagram, YouTube. Frank, you're pretty much on all of those, except you don't have a YouTube channel yet. I said yet because you're gonna.
There you go.
And we'll catch you next time. Oh, do you have
Thanks.
anything else, Frank?
No, I'm good.
All right. Yeah, we'll catch you next time. Bye. And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.